everyone. I'm Rick Bensignor. Today is Tuesday, October 6th, and welcome to this week's In the No Trader show. As we record late Tuesday morning, we've got the S&P having just given up its gains. It's trading at 3,400, so it's about down 8 points on the day. Yields have again moved up a bit. They're just shy of 78 basis points on the U.S. 10-year. Oil's having another solid day. That's 2 days in a row. About $40.50. That's been a rather significant move in just a couple days, and as far as I know, no major news. And let's see, gold is off about $6 or so today. And let's see, the US dollar is fairly flat, down just a couple of ticks. So today in our show, we're going to do the following. In our trader education portion, we're going to talk about indicator value inputs. In other words, why you choose the values that you do for certain indicators you use or moving averages, etc. So we'll talk about that because it really is rather subjective. In our market overview, we'll take a look at gold and bonds specifically this week. And then in our sector analysis this week, we'll take a look at semiconductors, considering how strong a group they are. So we'll look at the, let's say the SMH, the ETF, that's the popular one for semiconductors. And then we'll take a look at a dozen or so of the largest stocks within the group. So that's what we've got on tap for the week. Of course, I want to remind you about what you can get by being a subscriber to In the No Trader. Right now, we have two options for you. One is our weekly ETF tactical trader report that comes out Wednesday nights, and that concentrates on ETFs in the sense that we'll pick a new ETF to trade each week, review all our open positions, but also review the markets, and very specifically, we'll dig deep into the S&P, usually gold, the dollar, and sometimes bonds. And then the new report that started in August is the monthly report. We just released our second, or I guess actually it's our third, on October 1st. So we try to do it right at the turn of the month. And this is the 7-11 monthly report is the goal is to outperform the S&P. So instead of just buying spiders and accepting the return, our view is that we can outperform the S&P. And we outperformed again last month by 36 basis points. It's not a ton of outperformance, but we did outperform that. So the 2 months that we've been doing this, we are 1.36% ahead of the S&P. So if we can keep up, that rate, you annualize it, you're over a 7 or 8% outperformance. If we can keep it up, and at some point we know that one of the months certainly will underperform. It's bound to happen, but it's a medium-term report. It's not meant to get in and out quickly, so we're positioned in the sectors that we like. We do a little juggling of asset allocation, but basically we've been able to stay away from energy, from utilities, from REITs, and where we're doing better than the S&P. In order to reach me, my email address is rick@inthenotrader.com. All right, so let's start off our trader education portion. And again, it's talking about indicator values and why you choose, let's go back here, sorry. Indicator value input. So what am I talking about? So let's say you pull up a chart, and here, let's do that. Let's pull up a chart. So here's Apple, and we decide to put maybe, let's say, a 200-day moving average on Apple. We've got an RSI down here that's a 14-period RSI. And this is often, let's say, how people will start their analysis, something like this, a simple moving average. They may put a 50 here. Let's even add to this. Let's put a 50-day up there in addition. So we'll make the 50-day, let's say, red. And change this. So here we go. This is often, let's say, the starting point for people: a 50-day moving average, a 200-day moving average, and an RSI chart with a 14-bar input. And so let's talk about, why do you look at this? Well, you could say, well, textbooks tell me that that's these are good values to look at. A 50-day moving average, a 200-day. So let's kind of think about this in a sense of when these numbers came about, these input values, and why they are what they are. So let's even start with something like, let's go down to the RSI chart, a 14-bar RSI. So Wells Wilder, I think it was in the 1970s, came out with this book about RSI, how to use relative strength index. And ever since then, virtually every software package, or if you go back to even the 70s and 80s before they had computers doing this stuff and you'd subscribe to chart books, they would default to a 14-period RSI because that's what, let's say, Wells Wilder had in his book. And I think to myself, what is 14 periods? What's the meaning of it? And to me, can't think of any reason at all that 14 periods should mean anything at all to a trader or an investor. It doesn't matter. Whether it's 14 days, 14 weeks, 14 months, 14 in and of itself seems to mean nothing to me. If it was 15, then I could say, okay, it's on a daily chart that's at least 3 weeks. 15 days of trading. But 14, 14 times 2 is 28. That's not really half a month. So 14 days just doesn't make sense. So I'll ask you, why do you use it? Why would you pick the default value? And why do all the software companies use it as a default value? Well, they'll say that's just kind of the way it was initially designed. And yeah, I think that's how Wells Wilder did it. But it's now 40 years later, and I ask myself, does 14 mean anything? Well, it never meant anything to me in the beginning, and it still means nothing to me. So I myself don't use 14. So when I show my clients an RSI chart, it may not match theirs unless they've adjusted to using, let's say, what I use. That to me is much more intuitive. So I will take the standard 14 and I will change the input. Usually I think of 11. And I'll use 9, 10, or 11. And obviously it doesn't make a huge difference, but it makes some difference. So let's talk about, if you use 14, you're looking at what most other people are looking at. And therefore, there is some value to that because you at least know what other people are doing. And if yours gets oversold, theirs gets oversold. And maybe they'll do the same thing when you do it. And the collective movement of other people doing the same thing at the same time could potentially add value. But if I'm going to use an indicator, the indicator needs to make sense to me. Otherwise, I can't just use it because some person developed it and at the time said this is a good default value. So why do I choose 11? Well, I think of it this way. The average month has 30 days in it, but there's only 22 or 21 trading days in the month. So if I take half a month, which is kind of a shorter term view of looking at something, then you're in the neighborhoods of 11 periods, half of the 22 average trading days in the month. And there's some holidays along the way that take even more trading days out, right? So Thanksgiving there's only 30 days in November. We know there's on average, there's going to be 4 weekends of 2 days, so that cuts it down to 22 days. And then, Thursday of Thanksgiving every year is a day off, so that month only has 21 trading days. So half of that's 10 and a half. Well, I'm not going to put in a value of 10 and a half, so it's either 10 or 11, and so on. So most months, I'd say on average, are closer to 11. So to me, it's just more intuitive to pick a number that represents something that aligns with what I'm looking at. If I'm looking longer term, I also may not keep the same value for a daily chart as I would for a weekly. If I switch the chart, let me just apply Okay, so now let's say I switch it to a weekly chart. Does 11 weeks mean anything to me? Well, it really doesn't. But let's say 13 weeks does, because that's a quarter of the year. So I'm looking at a weekly chart. I probably want to switch this and go to 13, which obviously isn't going to be so different than Wells Wilder's 14. But again, I can't make any heads or tails out of why 14 should mean something to me. So I want you to think about why you use the numbers you do, and are you using them just because, well, it's easy and you don't have to do any thinking, and, well, heck, if 14 was good enough for Wells Wilder 40 years ago, it must be good enough for me now. Well, you could do that, but that's kind of a lazy way of thinking about things. And here, let's take a look at this. Here's the cloud charts, right? Ichimoku. I'll take the moving averages away. So you know there are 5 lines that make up the cloud chart. So besides the price, right, the indicator itself has 5 lines. The conversion line, which is the midpoint of the last 9 trading sessions. The baseline, which is the midpoint of the last 26 sessions. The leading span, A, which is the midpoint between the conversion line and the baseline, pushed out 26 bars, in this case 26 weeks, because we're looking at a weekly chart. Leading span B, which looks back 52 bars and plots the midpoint, but instead of plotting it in real time, it plots it 26 bars forward in time. And then the lagging line, which is current price, pushed back 26 bars. So this model is big on using 9 and 26 and 52. Well, back when this model was invented, which was the 1940s in Japan, there were 6 trading days in a week. So Hosada, the guy who created this, thought a week and a half was a good short-term trailing period to look at, and that's where he came up with 9. 26 had nothing to do with that. It was half a year. It's how many trading days were in the average month. Because they traded 6 days a week, you got, well, let's see, 6 would be what, 24, let's see, it's 4.3 times 6. I think that's probably close to how you get it, because there are 4.3 weeks in a month. So he used 9 and 26, and then he used 26 bars forward, which is, was represented half a year if it was a weekly chart, or a month going forward on a monthly chart, and 26 bars backwards. So there was reason for it. But let's take a look at and get a sense of MACD, which uses a 12 and 26. And I can't quite figure out why they are. And I will tell you, I generally use the default values of 12 and 26 for MACD because I know that's what most people are using. So I want to kind of see where they're leaning on a potential cross and whether or not I agree with the cross. And I think that, when you see a bearish cross, you're going to get some new sellers come in. And I'll either play in the direction of that because I have other reasons to be a seller, and this might be corroborating my bearish view, or I might say, this is crossing, but everything else I'm looking at is still bullish, and I'll maybe let it sell off and I'll let sellers come in, and then they'll come and buy. But I can't quite figure out 12 and 26 as being something. 12, I can figure 12 weeks or 13 weeks, it's close to a quarter. If you think that there's only 4 weeks in a month, then you think a quarter only had 12 weeks and you didn't round up properly. The point here is that you're looking at moving averages, you're looking at indicators, and you probably have no sense of why what you're putting on your charts is what you're putting on. They're just like default values. And I would say to you, think intuitively on some of these and decide if they make sense. And if they don't, do something that more matches what not only is intuitive to you, but also the time frame you're trading. And if you're a quick trader, then an RSI of 14 probably is too long. Even a daily chart of 14 is too long. I would say if you're a very quick in and out trader, day trading or just a day or 2 or 3 putting on a position, then you probably want to have an RSI that can be as little as 8 The point here is think about what you're using, and just because some book says it is, the default value, it doesn't necessarily mean it's the best default value. And unless you're just trying to see what the crowd is doing, and thereby you want to kind of see the default, even though you can see it, but it doesn't mean you necessarily want to use it for yourself. You can use it just in a way of exploiting what other people are doing. And that's today's little lesson on understanding input values and knowing why they are what they are, of what you're putting up on your screen. Okay, let's go back to our PowerPoint and take a look at, here we go, week over week. So in this past week, only 3 sectors have moved 1% or more versus what the S&P did as a whole. And once again, energy underperformed. It moved by about 3, it underperformed by 3% in the last week, and it is again setting new all-time lows. So it remains the absolute worst performing sector this year by obviously over 54% compared to the S&P. And you can understand if you're trying to outperform the S&P, if you're not in energy, even though it only makes up about 3% of the S&P, but if you weren't in that sector, you're already going to outperform the S&P. So, this year has kind of been a battle of energy, financials, REITs, and utilities, the latter 3 being interest rate sensitive, that have been the real bad losers. And as long as you can figure out how to avoid them, which we do through those spider ETFs, and we just simply don't get ourselves involved in the ones that we think are still going to underperform, we can beat the S&P. Excuse me. So those are the changes for the week. Utilities and REITs, where the outperformers make sense. Interest rates have moved up, and these are, again, interest rate sensitive parts of the market, as is financials, but financials didn't move more than 1%. Only moved about 40 basis points better than what the S&P did. So it didn't get, a dot here. But you can see the, interest rate sensitive things are starting to, and they should continue as long as rates move up. All right, let's go back to charts, and let's go to, take a look at, well, actually, let's start with the bonds. So, I've been saying for a long time that 10-year yields had to get above 74.5 basis points in order to have a breakout towards 90. And we've finally done it. So all the trend lines have been broken, and they've been broken for a while, but didn't really get you anywhere. But now we have, barring today selling down and having a low beneath 74.5 basis points. This is the TMAX chart. So the decimals 1 over 7.45 is the equivalent of 0.745%. So as long as today's low doesn't go lower than 0.745, then we have an entire day whose low is above this critical 7.45 level, and that to me is enough to say you have a short-term breakout, and that yields, doesn't mean we have to go straight up, but that there's a good chance here that you're actually changing the environment in the yield picture, and that yields should make their way higher. And that, again, would be, if that's correct, then you should start seeing utilities, REITs, and financials at least holding their own against the S&P, if not doing better. So I would pay attention to this and continually monitor it, and look for the 7.45 TNX level as a key level short term to where interest rates are going. The other thing is, we said we take a look at gold. So here's the weekly gold chart. The trend line broke a month ago or so, but notice that support was found at the baseline from the cloud chart. I was hoping to get down to 1836, which was the propulsion full exhaustion level, and we only got down to 1850. So I wasn't able, I missed adding new trading longs to gold. At this point, I'd actually expect some resistance on a pop-up if we got towards, the mid, I don't know, 1955-ish or so, where the conversion line is. I kind of think, I've been saying that between, in fact, since they were made, that would be the near-term high in gold, not only from this 13.9 combination, but also if we switch this and we look at a quarterly chart, notice that quarter that just ended on September 30th was a sequential 13 signal. And that to me means, along with the weekly 9 and 13, that there's a better chance that you have a near-term high. Now, longer term, I still like gold, and my longer-term upside targets are both 24.12 and 27.16. But there is reason to think, along with the propulsion exhaustion level here, that it could stall here, and I don't think gold likely takes out, makes new highs before the election. I've been saying that also since it topped. And I think for now, certainly this can finish out as 7, so an 8 and 9 count over the next couple of quarters. But I think that gold's high right now is the trading high, and look to play $150 range in between as it digests the recent gains. All right, let's move to the semiconductors, and we'll finish off today's show with that. So let's start with, here's the SMH on a monthly chart. So this is the full trading history going all the way back to 2000 when SMH started trading. So I wanted to just kind of show you and put things in perspective. So, the March correction went back under what had been all-time highs, but it was only intra-month, and we've zipped ever since there. I want to give you a sense also of where some long-term targets are, because we're through even monthly propulsion targets. So then what I figured I'd do is add the Elliott wave count, and this is called D wave, D being for Tom DeMark. So this is his, take off sequential so you don't get the numbers confused. This is his way of counting Elliott waves. It's all mathematical. So starting from the bottom here, we've got 1, 2, 3, 4. So we're in the 5th wave, and the 5th wave potentially measures up to about 224 from the current kind of 179, 180 level. So there's still the potentiality here for significant move higher, but there's a heck of a lot of risk too to first putting on longs in wave 5. And that's, that's the game that one needs to play. I'm long some of this sector on individual names, so I'm likely to try to hold onto them and look for continued strength, but I'm going to also pay attention to the 170 level and 156 levels if we get down there, and how we trade with them. I wouldn't let myself probably hold on to this beneath 156, because then it says it can get down to 128. So in my general fondness for the sector and seeing them do as well as they've done, I'll try to hold on for the chance. And then when and if we ever get up towards 224, then I say goodbye and I walk away with my profits and very content. All right, let's look at some individual stocks. So we'll do STM to start off. Notice how close this is to its weekly long-term target. So at this point, I'm pretty much getting out. If I have this name and I realize it doesn't match up, here, let me just look at the monthly if that changes anything. Okay, so the monthly target doesn't really change. There is no monthly target. So here's a name that actually you're very close to target. The upside is minimal. I'm not buying this name, and if I have it, I'm certainly willing to take profits on it. NVIDIA, also in a wave 5, let's put sequential on, put aggressive. Okay, so you're in a wave 5, and this week happens to be a 13, all right? Very high risk to putting on new longs. The 13 stop out isn't all the way up till 709, which is, I don't know, what, 40% higher or 80% higher, something ridiculous up there. No, am I reading that? 709. Yeah. It's a 150 now. It's I don't know, over 30% higher. So I can't really judge using this, but I know now that if I've got this name on too, it's not a crazy idea to take some profits. And you might give up some upside, yes, but we also now look at the last time you had, let's say, a 13 for upside exhaustion. You really couldn't see it coming, and then boom, the thing just fell in 2018. So you could trail, you could lighten up here. You could put some stops under, let's say, 505 if you wanted to on Friday closes. But this becomes a high risk to first putting on new long exposure. Here's Intel. Much weaker name, obviously not even near its highs, actually closer towards the bottom end of its range. I don't see, honestly, much to do here. You're in the same, average price as you were 2 years ago. That's a complete neutral type name. ASML has already reached and exceeded its fifth wave target. It peaked on a setup 9 count and hasn't done much since. Same type of thing. Don't mind taking a little off. If I've been a long-term holder, you've got some real nice profits there. Qualcomm, sideways for years, finally broke out this year. This is holding in a wave 3, and you're on a weekly 9, so another month of strength, you're going to get a 13. That's something that I would consider taking off. So again, just pay attention. Another 4 weeks or so of continued strength, that may very well be the time to take some off the table. AMD, also, shining star name. This is really outdone itself. You can see when it hits its fifth wave target back in 2018, and 2 weeks later it gets the 9 count. It pulled back, but now it's done a massive move since. So this is part of a different wave count. It's also in its fifth wave. This one I kind of like. I'd say, given the way it's trading, and I actually own this name from a long time ago. I actually got in on this 9 count here. I still have the last 100 shares that I had bought down here. Now I scaled out lots of places and sold way too low, but I still have the last 100 shares. And I'd probably stop myself if it broke under 71. Otherwise, I may try to let this one go. We have time for 1 or 2 more. Let's do Texas Instruments, something. A name kind of from yesteryear, but it's been a stellar stock. So this is still near all-time highs. 9 count recent high, call the high. I'd use the low from 3 weeks ago or 2 weeks ago, whatever this low is. If it breaks under there, I'd want out. Otherwise, I'd stay with this. And the last one we'll do, let's do Micron. That's my little timer telling me I'm out of time. So this is mid-range, nothing special here. So it's, there are other names that look better. That's it for this week. Hope you enjoyed the show. I am Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.